Hey, welcome back, everybody, to the FourStar Today's Market Explained podcast. We are getting ready to discuss some really important things in the financial world today. Thanks for being with us. I'm here with my new temporary co-host. We have Jack Walsh, Trader Jack. Jack's with us today. Hey, Jack, welcome.
Glad to be here, Brian. We got a lot to talk about today, don't we?
My God, yeah, we do. And Jack is a trader. Obviously, he's been on the floor of the Chicago Mercantile Exchange. Jack's a father of three, sports car enthusiast, experienced trader in interest rates, and all-around great guy. Last 15 years as a senior financial advisor, and now with FourStar. So thanks again, Jack, for joining us.
My pleasure.
And I'm Brian Castle, your founder and CEO of FourStar Wealth. I'm an Eagle Scout, trustee of the National Boy Scout Foundation, advisor to CEOs and insiders, chief dad to Quinn and Evan, husband to the amazing Tripty. If you like what you're hearing, everybody, we'd like to ask you to tell your friends, send them a copy of this show, and then also give us a 5 out of 5. That's the way we build our listenership, our viewership on the video versions on TikTok, Instagram, and LinkedIn and others. So we are going to talk about some interesting things today in the markets, the economy, what we see out there, and some things that are happening, some interesting experiences that we've had too that we want to share with you. So, Jack, some things have changed in the positioning of the 6 major asset classes since we last did a podcast and you joined me a couple weeks ago. And why don't we start out with that? Number 1 was international equities. Was that right, Jack?
That's right. It went from 246 up to 250, 4 points. Taking number 2 was commodities, jumping from 188 up to 208, up 20 points. Cash fell back to third, going from 207 down to 195, down 12 points. Domestic equities lost a little bit from 184 down to 181, down 3 points. Fixed income fell a little bit from 137 down to 133, or 4 points. And currencies are in last, going from 132 down to 122, down 6 points. So I guess the interesting thing there, Brian, is the jump up in commodities again.
That's right. So that's the big story. And then domestic equities is within shouting distance of number 3. So we've gone from a bear market model to a little more riskier model with international stocks number 1, commodities number 2. That's kind of surprising. We'll have to talk a little bit more about that. And then domestic equities are 4, but almost in the 3 position, getting very close to overtaking cash. So that's not what you see in a bear market. You usually see cash, currencies, fixed income up at the top. So we're seeing like a rally phase here. Now we'll see if it holds. But the most surprising thing, Jack, is the commodity piece. So commodities last year had a very good year. It was the best commodity year since 2010. So it had been 11 years since we had, or 12 years since we had a good commodity year. But last year was all about grains because of the war in Ukraine, and then energy, like oil and oil related. But this year it's not grains anymore, is it? It's oil and
gold. And I think
gold.
You could put number 1 and number 2 kind of in the same group, because the big story this year, from my perspective, is the relative fall in the dollar, right? Last year we had strong dollar. The Fed was hiking rates aggressively. So now that the dollar has been falling, the dollar index is going from about 114 down to 101. You've had international stocks pick up, and you've had commodities, and commodities led by gold, right? So, I think the theme is the same, right? It's been 15 years since we've had international stocks in the lead. So it really is a dollar story. And Brian, we've been saying this for 16 months now. It is a Fed story. And
Yes. So gold's near an all-time high, but now that we've had this big rally in gold, it looks like it's fading a little bit, but in the numbers we can have coming into today. Gold's still holding up, but now we're seeing a little bit of pullback in gold after a big rally. And, the funny thing is, when cryptocurrencies came into being, Jack, we saw cryptos come in, and then people were upset about the dollar, upset about the economy, whatever. Instead of buying gold like everybody did, they were buying Bitcoin and Ethereum and all these cryptos. And now crypto isn't as hot as it was, although it is rallying. It went to 64,000 at one point on Bitcoin, just to use that as an example. Mm-hmm. So people would say now Bitcoin is the new gold, right? We don't need gold anymore because we've got Bitcoin. Well, now we've seen trouble with Bitcoin, and so gold's rallying when we have financial issues. So now gold is the new gold, isn't it?
Yeah.
All right.
Well, if you like gold, people start to call you a gold bug, right?
Right.
But yeah, you're right. I mean, we had the big explosion in crypto, and everybody was involved. You had celebs doing ads, and we all know what happened with Sam Bankman-Fried, right? Crypto, people were skeptical, right? But people are skeptical about fiat currency, right? I mean, what happens to fiat currency over time is the government devalues, right? Mm-hmm. So for many years, people would hold wealth in gold, right? Yeah, crypto took that gold spot, right? Now, I like to always say the government makes the rules of the game, right? So there's a very strong banking interest, and crypto, by its nature, was kind of against banking interest, right? So, who's gonna win out? Well, we know that the banking lobby group is very strong. So I'm not saying that banking is going to go away. You and I, even though crypto was on fire, we're always skeptical, right? Because government makes the rules. And now, gold, the hedge for 5,000 years, is starting to gain strength. And Brian, I think it's only been above 2,000 for 7 days out of its entire history, right? So we're in this range now between 2,000 and 2,050. And what's interesting is that the market is still saying that the Fed's going to go another 25 basis points, an 84% chance, right? And gold historically sells off at least slightly when you have rising interest rates. So we're stuck in this 2000 to 2050 range. The Fed's likely going to move rates another time. And then the question is, what does that do to the dollar? Do we see a slight bump up in the dollar? I think the Fed is in a very difficult place here, right? Because they would like to pause, right? When the Fed does pause, everybody's going to sell the dollar. Everybody's going to rush into commodities. So even though the market believes that that's close to happening, the Fed doesn't want to signal that they're going to pause. The Fed wants to be the ultimate inflation fighter, the Paul Volcker, right? So right. We'll see. Well,
they can't signal that because then people will take their interest rate increase seriously. So they want to keep moving. As long as they're moving in one direction, they can't focus on anything other than that direction. And that's where they are right now. So we're going to probably, you say 84% chance, according to the betting people on the floor, that we're going to see a 25 basis point increase. But gold is now doing the things it normally does when there's concern about the economy and the dollar. So gold starts going up. Gold's kind of doing its same old function. But don't forget that in the 1930s, Franklin Delano Roosevelt outlawed private ownership of gold. So if it gets too crazy and the government doesn't like the fact that everyone's buying gold and getting out of dollars, you never know. They could even get rid of gold. We saw the Chinese government get rid of cryptocurrency. That became outlawed for any citizen in China. And then they created their own cryptocurrency for Chinese citizens to buy. But isn't the whole point of gold or cryptocurrency is to be outside the profligate governments who keep spending money and printing money and running up debts and everything else. The point is that we're worried about all those things. Why would we want a cryptocurrency made by a government? It makes no sense, right?
Yeah, well, that goes back to the system. The government makes the rules. They make the rules to the game. So there's plenty of instances when people had a so-called trade figured out, and they thought they had it, and government will change the rules, right? The one thing I would say about gold is we have all these different products, GLD, GDX. So you have a massive amount of derivatives, right? So nobody is buying gold and sticking it under their mattress. I would say very, very few people are, right? But you always have this derivative to go to, right? And then the big fear, Brian, is that as the Fed raises rates, something's going to break, right? And we saw that it was Silicon Valley Bank, right? And then we had for 2 to 3 weeks, we have big outflows from small regional banks into money market funds, right? So I don't think, especially with the Fed keen on raising at least one more 25 basis points, that we could be sure that the so-called breaking, the credit event, many analysts on the street said the Fed is going to tighten until something breaks, right? So the argument against tightening anymore is they did kind of cause at least a small run on the banks, right? But they have not solved the inflation problem. So it's a very complicated picture right now.
It really is. Well, and so we had this big bank run, and it's really quite an irony. Now people are more interested in being in a regular money market and not in a bank deposit program, because the banks are fractional reserve institutions. They always have been, but there's new scrutiny put on banks because the banks really didn't have the money there. But the banks have never really had all the money there. They lend out all that money. They only keep 5% of the money that's in the bank. And the reserve requirement is what the Fed plays with to manage the risk of a bank. Well, all of a sudden, everybody got really concerned. And then some of these banks were, getting a run. And then it all happened overnight where people are electronically moving their money back in the old, It's a Wonderful Life days. People had to line up to a bank. It took days and days and days for a bank to go down. As everybody stood up and said, I want my money, and I want my money, and to go to the teller. And then the last guys who showed up didn't get any money. The bank failed. Well, Now it can happen electronically. So everything changed. And in fact, also the other thing that's different, everyone remembers in 2008 and 2009, people were worried about investment banks failing. So Merrill Lynch was acquired, Bear Stearns was acquired. So all these banks were acquired. And then what the federal government did is they made all the investment banks commercial banks and guaranteed their deposits up to a certain level. So everybody wanted to be a bank back then. Now nobody wants to be a bank because they're concerned about the risk of the bank. They want to be back in a money fund and not in a bank. So it's really strange how things play out, that banks were the most important thing and the bank guarantee just was golden 2009. And now it's not, right? They're not so concerned. So they had to actually guarantee all the bank reserves of Silicon Valley Bank, all the depositors, not the shareholders, but the depositors. So it's really just a strange environment. But now Jamie Dimon says the banking crisis is mostly over, right?
Yeah.
So
well,
let's hope he's right.
What I think is interesting about that, Bri, is that you and I know that the small regional banks and even the smaller banks, they are the lenders to small businesses. And those small businesses create 2/3 of the jobs, right? And exactly what you said, as the story goes, Silicon Valley Bank lost $40 billion, withdrew in hours, right? So, when we think about banking and It's a Wonderful Life, nobody thought with all this great technology and, touching your phone, that the banking system or banks could lose massive amounts of deposits in such a short time. Now, the smaller banks, they need those deposits to run their business, right? The JP Morgans, the Citibanks, they could fund themselves in the markets. So, now the question is does the government really want a contraction in the overall amount of banks, right? And I would say I would rather not have a contraction in the amount of banks, but I'm not sure what the what the theory is there,
Yeah. Well, they've reduced the number of broker-dealers in America. Maybe they want to reduce the number of banks because now technology allows you to pull money out so quickly that, there's nothing unique to a local bank now if you just pull your money out electronically. So, everyone's so active on their phones. Even 5 years ago, we weren't as active on our phones. So I guess the systems got faster than the banking system was able to handle it. And that's where we are now. So it's a strange time, but I think hopefully Jamie Dimon is right. And hopefully the banking crisis is over and maybe we don't need to buy gold. Maybe gold's going to fade. Gold going up is not necessarily a good thing, right? That means there's other trouble in the system. Same thing with Bitcoin. So let's hope that we get our normal currency system back up and running the right way and that we go back to normal business without all these things crashing and breaking all over. We've chronicled on this podcast series how Credit Suisse went under twice. It went under, it was saved, and then it finally went under, it was acquired by UBS. We had two currencies in trouble, the UK, the British pound, the Japanese yen. This all happened last fall. So now we're having more trouble with the banking system, but hopefully it's over. Jack, as far as the economy is slow and getting a little slower. Will we have a recession? Won't we? We're not sure. But while we're having these slowdowns and lots of layoffs, turning to the economy, the travel industry is super, super strong. We're having the biggest travel boom in American history because that's kind of maybe a pandemic backlash. And the restaurants are strong, but consumer spending is generally not strong. The S&P 500 is near highs for recent markets. We bottomed in October, rallied, pulled back, and now we're rallying again. Many analysts are saying that we're getting near the end of this rally and we're about ready to go now down and go to break new lows as like normal bear markets would do. If the bear market's not over, we'll break to new lows. So you say, Jack, the last Fed rate hike is the one to sell since the Fed can't kill inflation anymore?
Well, that has been the history, Brian. The markets always seem to make us look a little bit foolish sometimes, right? But the thinking goes that with the last Fed rate hike, we're going to see rising unemployment. We're going to see bad economic numbers, right? Really bad economic numbers forces the Fed to stop, right? This idea that we could have a really big shoe to drop in as far as commercial real estate goes, right? That's what the market really fears. And you and I know that the cities, there's fewer people. I take the train down every day. There's very few cars at the parking lots, right? So getting back to your original question or thought is that, yes, the last Fed rate hike, you're supposed to sell the stock market. And that is because the economic numbers are going to get so bad, unemployment is going to rise. It's going to force the Fed to stop raising rates. And that's kind of what we see in the markets that I used to work in. They expect one more rate hike, and then they expect by September and December, the Fed to be cutting rates. Most analysts now think second quarter GDP is going to be negative, right? Now, they expect a rebound in third and fourth quarter, and actually earnings are not looking as bad as they did at the beginning of the year. Most analysts were talking about S&P earnings being around 205, 195, and we were using price to earnings ratios around 17 or 18%. that could see the market get back down to the 3,500 number, right? Just before the call, I was looking at earnings projections, and now they're back up to around 219, 225 S&P. You use the same multiple, you're looking at fair value in the S&P being around 3,800 to 3,850. So maybe that doom and gloom, that final, what they call blow off move to the downside, maybe that doesn't take place. But it seems like the market is still a little bit so-called rich at 4,150 to 4,200, right? That's why you have the Mike Wilsons looking at models going back and saying, we still think the market has one more leg down.
And Mike's from Morgan Stanley, also Mike Hardnett from B of A, also saying things like that. So a lot of people are predicting another big move down, assuming that what all the models say. We're not sure if that's going to happen, but we certainly, have a potential commercial real estate crisis coming up. The banking crisis is hopefully over. If it's not, then that creates other trouble. There's lots of layoffs going on. So it's an interesting time. But the market does know all these things. So maybe the market's already got that baked in, and we're not going to have as big a problem going forward. So we watch and we wait. Interestingly enough, last year during the really, really difficult year, the economic numbers are coming through better than expected. And in fact, they came through better than expected 11 times in a row. We've never seen that before, beating expectations every time. And, one of those things, when you keep seeing numbers that defy logic, you're like, well, why does it defy logic? Maybe there's somebody's got a finger on the scale or something. So a lot of these numbers are coming out from the government. Well, sure enough, later in the year, the government admitted that maybe their estimates were a little bit too optimistic and they had to revise things downward. Now we're seeing numbers doing better than expected again, every quarter, every number. We're wondering, is that real or not? Are we getting gaslighted by our own government as far as numbers? We're not, Jack, I'm not sure. I don't know if anybody's sure, but it did happen last year. They finally admitted they were doing that. Maybe they're doing that again.
Well, Brian, I've been in the business for a long time, 35 years, and we notice things like this, right? And exactly what you said, stats saying that a number like unemployment to beat expectations 11 times in a row, it has just never happened before. And then we would notice when I was working on the floor that later on they would get revised down. People have talked about the birth-death model and how they do a plug for small businesses. But what it does do is that big number earlier in the year, I want to say it was a January number, that 517,000. The market was getting into this idea that the Fed might stop at 4%. But after that number, then you had Fed speakers come out and people were talking about 6%, right? So that drove another leg higher in interest rates and provided some stability for the dollar, and now we see, even though everybody expects the unemployment rate to rise, we are still seeing relatively strong numbers. So
yes,
what it does is it gives cover for the Fed to continue to raise rates all year. It's been the market is going to predict, the Fed's going to pivot, and the Fed keeps pushing back and saying, no, we're not going to pivot. So it's really a very interesting time and a very Fed focused, so much where people actually kind of complain that the market is moving 1 or 2% on an unemployment number or a Fed meeting. So very interesting times.
Well, then we saw a retail sales number, Jack, where the number was down 1%, and that's a much higher percent for the whole year. So one of the top strategists in the country, Louis Navalier, calls that a disaster, and I agree with him. So we're seeing some negative numbers, some positive numbers. Maybe if we're being gaslit about the numbers being positive, they're trying to get the Fed to raise rates so that way they kill inflation. Inflation's still here. It's waning a little bit, but there's still elements of inflation in our system that need to be wrested out. In the last administration, we had an average inflation of about 1.5%. So low inflation. We need between 1% and 2% to have a normal economy. But now we've had much higher inflation during this administration. So maybe they're purposely gaslighting us on numbers to give the Fed the impetus to keep raising rates to kill inflation. So we'll see how it all plays out. And we don't want inflation to become entrenched. Some people think that it has. We have seen the largest collapse in corporate credit in the banking industry in 20 years. So banks aren't lending either. There's very, very tight margins. And so even though money costs much more money, it's much more costly at higher interest rates. But then the banks aren't lending because of all the issues involved in the economy. They're unsure of who to lend to. So we're seeing also some changes now in employment. Now, we still have about estimates of 6 to 7 million able adult men at home, not working, on assistance. And so we're wondering whether that's going to change. We have a tight labor market, even though we have a tight economy, and they're showing some layoffs, but there's still a tight labor market in certain areas. So people are probably not qualified enough, Jack, for some of those jobs, I think.
Yeah. Well, Bri, COVID really changed things, right? Yeah, I mean, it's a very tech-dominated workforce, right? I think when people have been out of work for more than a year, that they get very discouraged. Businesses, once they train people, they want to hang on to them. Employees, they want to work from home 2 days a week, 3 days a week. So it's a very different workforce. And just to go back to inflation, when you look at, what was happening, what was going on for the previous 20 years, you had what you would call a labor arbitrage, right? Jobs were getting outsourced to China. Jobs were getting outsourced to India, different cheap labor places, right? It was a huge savings for companies. Companies became very, very profitable. Well, now they're saying it's not offshoring. Now it's onshoring. You have jobs, companies, Intel building a huge factory in Ohio. So those deflationary forces globally are now not in play because of, places want stable parts, supplies. So it's a big deal for the bond market. It's a big deal for the Fed. It's a huge structural change.
Well, yeah, so a lot of things are changing. We're onshoring now. People are coming back to America. Our companies are coming back to America, and work employment is coming back to America. That could be part of that strong employment trend. We're also seeing a move away from China. China is very, very aggressive about their intentions to be the strongest economy and the leader of the world, and they seem to have tactics that are very different than America's, where they're a dictatorial society, communist society, and they will force people to do things. In America, it's all done by coercion and incentives. So they're a very different organization. This weekend, I was at a conference in Nashville and saw the former president, President Trump, speak about things that we need to do. And of course, he's itching to run for president again. But one of the things he was saying is that he thinks we need to leave China altogether. China is our adversary, not our competitor, according to him and many business leaders. And so we need to make sure that we're not incenting them or doing anything that would help China take control of America. China's communism, its control, the wrong incentives for people. On the other hand, another very big country over there in Asia, India, the world's largest democracy. It's also capitalistic. They have elements of socialism in India, but they're going the other way. They're going more capitalistic with Prime Minister Modi changing a whole series of rules to force people to compete better. He did that currency analysis and figured out he needed to get rid of certain currencies that were being stolen by certain people in their economy. So he's changed a lot of things and created much more competition, freedom, capitalism, reducing bureaucracy. So now many folks are moving either jobs from China to America or from China to India. So they're leaving China because of all the issues there. But China is being very aggressive. They're spreading money all around the world. China is in the middle of what is one of the biggest population collapses. They admitted that their population was down 800,000 people last year. Many observers think it's significantly more than that. And China never really often tells all the numbers exactly, because if they're embarrassing, they don't tell them. There's also concern that China has had many, many more deaths from COVID than they're admitting as well. So in that backdrop, we're concerned about China, and we don't want China basically to take over America, but yet so many people are getting swayed. Didn't Emmanuel Macron talk about, he wanted our help in Ukraine, and now he's buddying up to the Chinese now as well with the country of France.
Yeah, I pulled up one of the quotes here. After his visit with Xi, he was doing an interview, and it basically came down to this: the question Europeans need to answer is it in our interest to accelerate on Taiwan? And he says no. The worst thing would be to think that we Europeans must become followers on this topic and take our cue from the U.S. agenda and the Chinese overreaction. So that is very interesting, right? I mean, didn't we play our part as far as France in World War II? So to see a so-called ally basically not have our back and move towards China is really it's just shocking to me, right?
Yeah.
So you could see where the world is divided. The Saudis are going to sell oil to China, and they're going to accept yuan, right? That hurts the old school petrodollar system, right? You can see where Europe, at least some of Europe, is stuck in the middle. They don't know where they're going, right? So yeah, all it does is make for a very interesting investing environment. And we have our investment meeting, and we consider everything when it goes to what we buy and what we sell.
Yes. This is a very confusing time. There is a lot of risk in the system. The economy is slowing down, but then there's countervailing forces that are keeping it up. We're not sure we're getting the right numbers. We have competitors out there. Very, very confusing time, very controversial time. So we're being defensive, although recently we did add some money and add some risk to the portfolios because the markets were going up. We needed to be there, but we will, of course, reverse course if they go back down and either take out some small profits or small losses and then protect the accounts from there. So we have the FourStar protection program in place that if the markets were to tail off, we go to what we call maximum cash level. That we'll do that. We did that very successfully last year, where most of our clients were down less than 10% in the stock market. That's down 20 and 35%, with tech even down more than that. So we're going to continue with that kind of protection plan, Jack, if things get rough. But it's a very confusing time. Everyone should be very careful out there. If you'd like us to help you and help you guide you through that, we're happy to do that. But with all these different inputs, good and bad, it's a very confusing time for everyone. Even the professionals in our industry, everybody is a little confused. But we will play out our strategy, and we're certain we'll have some decent success. So Jack, we're coming into the spring now, and the spring does bring a lot of changes. And of course, one day in our home city here in Chicago, we had a 74-degree day on Saturday, and now it's snowing today. In fact, it's so cold out there that they canceled a baseball game over it. So it's a strange time from that sense too. Summer's coming, but it never comes in easy in Chicagoland in the upper Midwest. So that's what we're seeing. But people are out again in Chicago. The cities are back. Chicago specifically is growing faster in the downtown than most of the other major cities. New York and LA not recovering as well. So things are alive again. It feels good. Like I said, we have this strange situation with weather. One day in Chicago it's 75, next day it's below freezing and snow. So anyway, we're almost done here for the day, folks. We just wanted to share some other thoughts with you. We do have some leadership matrix posts that are up there. Have a look at those. We have a piece about the number of people working from home. We talked about people wanting to work at home, people wanting to go to the office, employers noting that they're not getting as much productivity from people who are working at home. Yet people desire to work at home, and maybe some people aren't working so much when they're at home, but they're saying they're working. I mean, there's all these issues with all this. But that's an article up there. Also, on the Leadership Matrix on the FourStarWealth.com website, we have an article about sleep and how important sleep is. As now we get back to the office, we get back to business over the last year or so. People getting enough sleep. So we have a whole thing about counting sheep and ways to get sleep to make sure people get enough sleep to be successful in the economic environment. So, and one last thing, Jack, that I wanted to share with everybody. I had an interesting experience that I had last week. Many folks know that I'm involved with the Boy Scouts of America, which is one of the great social service agencies training youngsters, not just young men anymore, it's young men and women at all levels, citizenship, leadership, and other aspects of building a good life. We had a very interesting experience. I was asked to be part of a team that met with Captain James Lovell, who is the leader of the Apollo 13 mission. And Captain Lovell is 97 years old, I believe, and he's living in Lake Forest, Illinois. I was part of the contingent that went to present him the Distinguished Service Award of the National Eagle Scout Association. And I'm going to put a photo up on the screen for folks to see. And this was us up in up at the location that he's living in. There's Captain Lovell in the middle and members of our delegation. I'm the guy on the right with a suit on. I thought I'd wear a suit in honor of James Lovell. And, clearly he talked about things that maybe people don't remember, that our space program has been the most successful space program in the world. And he was part of a mission essentially that was busted. It became very popular because they actually came back to America. They were expected to die out there in space, but to get home, they had to send their craft around the back side of the moon, or the dark side of the moon, as they call it. And I don't know if people realize this, but the moon does not rotate. So every time we look at the moon, we see the same thing, because the moon just goes circular and does not rotate. So no one sees the other side of the moon. So if anybody remembers back in the 1970s, Pink Floyd saying about I'll see you on the dark side of the moon. Well, no one's ever seen the dark side of the moon except Jim Lovell and his two colleagues in the Apollo 13 mission. Jim Lovell told me that he asked Tom Hanks to say his eulogy when he finally passes away. Tom Hanks played Jim Lovell in the movie of the same name, Apollo 13, and so that's going to happen. And so we're just very proud to be with Jim Lovell for a day. Great American, also very successful in the economic world, and just some great Americans. And that's really what America's all about: achievement, success, and doing great things. Very, very ordinary people can do great things in America with the great system that we have. So that's all we have for today, everybody. I will see you on the dark side of the moon, Jack.
Yeah. Thanks, Bri. Hey, Joe.
All right. Why don't we leave it there, everybody? We'll be back with another great episode very shortly, and we'll see what happens over the next couple of weeks, and we'll be back here to report it. Thanks again. And that's it for today from the Today's Market Explained podcast.